The world is about to discover what silver actually is. But here is the uncomfortable truth. By the time the world finally understands it, there won't be enough silver left for the world to buy. That's the paradox we're walking into, an entire global economy built on the assumption that critical materials behave like digital files. People think supply can be refreshed, updated, downloaded, expanded, scaled, but physical atoms do not obey digital expectations. And the sooner you understand this, the clearer the coming years will look. We're not heading into a temporary shortage, we're heading into a structural era, one where silver supply may not normalize until deep into the 2030s. Not because of politics, not because of recession, not because of interest rates, but because time, physics, and industrial demand have collided in a way the financial system wasn't designed to handle. And now, for the first time in modern history, the gap is widening faster than it can close. Let me start with a harsh line that needs to be said plainly. Markets can ignore reality for a while, but they cannot ignore physics forever. And silver is governed by physics, not opinions. You can argue about valuations, predictions, or trading strategies. You cannot argue with depletion rates, geological timelines, or industrial consumption curves. This is the real story. This is the layer most people never see. Before we go deeper, let's anchor one truth. When silver breaks out after 45 years of pressure, you don't get a trend. You get a repricing. We are not watching a commodity going up. We are watching a system reaching its pressure limit. To understand why, you must first understand the part people consistently misunderstand. Silver supply cannot be scaled like software. A silver mine is not a new phone app you can build in 3 months, nor a server you can spin up in minutes. It is not cloud storage you can upgrade with a click. It is an industrial, geological, regulatory, environmental, and financial monster that takes years, many years, to bring online. And that lag, that latency, is the fundamental reason the next decade is not about price volatility. It's about structural scarcity. Let me illustrate this with a real sequence, a story that has repeated itself hundreds of times. A major silver deposit is discovered somewhere in Latin America. Geologists celebrate. Investors get excited. Articles are written about huge future supply. But discovery is not production. After discovery, the company must perform environmental studies, years of analysis. They must submit reports, hundreds of pages long, to satisfy regulators. These regulators then take months or years to review and demand revisions. Communities must be consulted. Water systems must be assessed. Land agreements must be negotiated. Financing must be secured, tens or hundreds of millions. Construction begins only after all this, and construction itself can take 3 to 5 years. Then comes ramp-up, training workers, calibrating equipment, stabilizing output. From discovery to real industrial-grade silver could easily take 7 to 10 years. And that assumes nothing goes wrong. Usually many things go wrong. Why does this matter? Because demand is rising right now. The world wants the silver today. Solar manufacturers want it today. EV producers need it today. The grid needs it today. But new silver cannot appear today. There is no shortcut. And so we enter what I call the timeline mismatch, the defining truth of this entire market. Industrial demand moves fast. Silver supply moves slowly. And whenever speed collides with slowness, pressure builds. That pressure is now breaking into the open. If you want the simplest summary, here it is. We're consuming more silver than we produce, and we've been doing it for years. And once a deficit becomes structural, once it compounds, once inventories begin draining, once industries bid against each other, you don't get stability, you get acceleration. Let's zoom into the surface level signals, because this is where most people begin noticing something is wrong. Silver sitting around $58 or $59 isn't the main story, but it is the first sign the world is waking up. At that price, nearly every investor globally is profitable. This generates what I call a global profit signal, a psychological threshold where everyone, everywhere, holding silver is suddenly in the green. And when that happens, people think the same thing. Should I sell now? It's a logical question, but it is built on a dangerous misunderstanding. You don't sell at the start of structural recognition. Selling silver right now because it has gone up is like selling Tesla stock at $4 pre-split because it doubled. You're not exiting because the opportunity is over. You're exiting because you never understood the opportunity in the first place. This is where charts tell the truth the news refuses to cover. We have a short-scale breakout. Fine. A long pattern breakout from 2011. Stronger. But the most important, the 45-year pattern. That's not a rally. That's not momentum. That's a structural reset. When multi-decade pressure finally breaks, the move is not linear. It's not gentle. It's not manageable. You don't drift upward. You slingshot. This leads us to the first retention peak moment, recognizing that most people think in price action, but the market is functioning in a completely different mode. Repricing. A repricing is not a trend. It is a transition from one equilibrium to another, usually violently. Silver is not becoming more valuable. The world is finally realizing how undervalued it has been for decades. And yet, even this is not the core issue. The deeper truth lies underneath the trading charts, in the infrastructure of the market itself, a system built on derivatives, promises, IOUs, and digital claims that function only if people don't ask for the real thing. The silver market has been running an illusion for years, dozens of claims on every ounce, digital tickets for physical seats, 1,000 promises backed by a single atom, and this system works perfectly until someone demands physical delivery. That is what we are now drifting toward. Think of it like a concert hall with one seat. Digital platforms keep selling tickets, and everyone is happy because no one plans to actually sit down. As long as no one asks for a chair, the system works. But once people start demanding their seat, once enough buyers insist on physical silver rather than digital claims, the entire structure collapses instantly. Not slowly, not gradually, instantly. Let me give you a real situation that captures this perfectly. A major factory attempted to secure a few million ounces for long-term production. They contacted suppliers. Normally, they'd receive shipments in weeks. Instead, they were told, minimum 6-month delay. 6 months. For an industrial input they cannot substitute. So what did they do? They went directly to the physical market. And their purchase didn't just fill a need, it squeezed availability for everyone else, accelerating the pressure. This is the kind of event that cascades. One industrial buyer stepping into the physical pool shrinks the pool for everyone else. Now imagine hundreds doing it. That's not a market. That's a bidding war. This is where reality catches up to the system. The silver market is rigged in a predictable way, not corrupt, but fragile. Fragile because it was built on the assumption that physical demand would remain predictable. But once physical demand becomes unpredictable, the derivative structure can't keep up. Promises cannot backstop scarcity. Paper cannot conjure atoms. Software cannot generate supply. Now we reach the fundamental layer most analysts never talk about, structural deficit. For 7 straight years, the world has consumed more silver than it produced. This is not a one-year fluke. This is not an anomaly. This is a compounding imbalance. More than 1 billion ounces have disappeared from global inventories, gone, not moved, not shifted, consumed. Used in solar panels, electronics, medical applications, sensors, applications where silver is not stored for future reuse, but permanently removed from circulation. These ounces will never return. And once inventories fall below certain pressure thresholds, you don't need to hit zero for the system to break. Reservoirs don't fail when they hit empty. They fail when pressure collapses, when the outflow exceeds what the structure can sustain. Silver is approaching that point, not a point of zero supply, but a point where the remaining supply no longer supports industrial continuity. That is far more dangerous. Industrial demand is the most misunderstood piece of this puzzle. The world sees silver as a commodity. The global economy sees silver as infrastructure. Without silver, solar production slows. EV efficiency drops. Electronics fail. Medical devices halt. The grid loses resilience. Silver is not optional. It is required. And here's the part that should make you sit up. Most of the silver used in these applications is not recycled. Not because recycling is impossible, but because it is uneconomical at small scales, which means silver, once used, disappears. Gold is hoarded. Silver is sacrificed. At this point, you should start seeing the shape of the problem: supply that cannot scale, demand that cannot shrink, and a financial system built on digital claims for physical goods. These three forces are converging, and the convergence is accelerating. Now that you understand the physical limitation, the timeline problem, and the derivative illusion, we need to go deeper into the psychology that drives market transitions. Because here's the strange part: scarcity does not begin when something becomes scarce. Scarcity begins when people realize it is scarce. Those are two very different moments. One is physical reality, the other is social recognition. And markets move when recognition spreads, not when reality changes. In silver, the reality has already changed. Recognition has not. That gap between what is true and what is believed is where the dramatic phase lies. Most people think they are seeing the beginning of something. What they are actually seeing is the end of the ignorance window. Every market has this window, a period where the truth is already baked into the system, already structurally inevitable, yet still emotionally resisted by the crowd. During this phase, early movers position quietly while late adopters laugh, mock, doubt, and dismiss. This is not unique to silver. It has happened in every transformative shift in history. But silver is unique because the lag between reality and recognition is unusually large. The world is consuming more silver than it produces for years. Inventories are collapsing. Industries are fighting over future supply. And yet most investors still treat silver as a speculative side story instead of a core infrastructure asset. That misclassification is ending. To understand how recognition unfolds, we need to map the 6-stage scarcity cycle, not the fluffy version you see on social media, the real psychological path markets travel when structural supply constraints hit. Stage 1 is undermined. This is when the asset is actively dismissed. People say it's outdated, irrelevant, useless, or boring. They prefer narratives about new technology or new financial instruments, and ignore materials that actually underpin the world. Stage 2 is undervalued. This is when the price begins to rise, yet sentiment remains skeptical. Analysts explain away the rise as temporary. Traders call it overbought. Retail investors shrug. But under the surface, early adopters are accumulating. Stage 3 is unchained. This is the first breakout. The crowd notices something is happening but cannot process its scale. They assume it is a short-term spike. Stage 4 is unstoppable. This is when the industrial buyers begin to panic. They are not investing. They are securing survival inventory. And when industrial buyers enter the same field as investors, the game changes. Stage 5 is unobtainable. This is not when silver hits a high price. This is when no price can guarantee supply. Delays stretch from weeks to months, then to quarters. Stage 6 is unaffordable. This is when industries themselves begin to suffer from scarcity. Factories pause production, projects are postponed, economies absorb higher costs. At this stage, retail investors are locked out. They will not buy because they cannot buy. Now here is the mirror moment you need to absorb. We are somewhere between stage 3 and stage 4, but the world thinks we're still in stage 2. That misalignment is the opportunity window, not because you're smarter than the market, but because the market is still emotionally anchored to old assumptions. The market thinks silver is cyclical, but the fundamentals are structural. The market thinks supply can respond, but supply cannot scale. The market thinks silver is an investment, but silver is infrastructure. When the narrative shifts, the move will not be incremental. It will be exponential. To illustrate how industrial panic accelerates scarcity, consider this. Industries don't buy silver because they want to profit. They buy silver because they cannot function without it. Investors can delay. Industries cannot. Investors can reduce exposure. Industries cannot substitute their inputs. Investors can buy dips. Industries must maintain production lines. And so when scarcity hits, industries don't buy gradually. They buy aggressively. They buy to guarantee continuity. They buy in multi-year contracts. They buy in bulk. And once they step into the physical market, they absorb supply faster than investors ever could. This brings us to a pivotal truth. Silver is the only critical industrial metal with both monetary history and non-recyclable demand. Copper is recyclable. Aluminum is recyclable. Lithium is recyclable with effort. Gold is virtually 100% retained. Silver, however, disappears into the infrastructure of civilization. It becomes embedded in circuit boards, solar layers, sensors, medical devices, batteries, and conductive components. Most of that silver will never come back, not because we don't want to recycle it, but because recycling would cost more energy, more labor, and more money than sourcing new supply. That dynamic means the world is burning through a finite resource faster than it can replace it, and faster than it can recover it. Let's step into the reservoir analogy again, because this is where many misunderstand. People imagine a reservoir as a big tank. When the tank is empty, the supply ends. But this is wrong. Reservoirs function based on pressure, not volume. They fail long before the last drop is reached. The collapse happens when pressure falls below the threshold needed to maintain flow. Silver inventories are not just getting smaller, they are losing pressure. You don't need inventories to hit zero to trigger panic. You only need inventories to reach a point where industrial buyers doubt future availability. Once that doubt enters the system, behavior changes instantly. And when behavior changes, supply disappears faster. This is the reflexive loop that accelerates scarcity. Now let's talk about leverage, because leverage is the invisible multiplier of every scarcity event. Most people think leverage means borrowing money to buy more assets. But the real definition is simple. Leverage is owning something the world cannot print. Leverage is holding what cannot be replaced. Leverage is owning what cannot be manufactured instantly. Silver, in a world addicted to digital abundance, is a form of anti-software leverage. Software can multiply, silver cannot. Software can scale, silver cannot. Software can expand without limit, silver cannot. This leads us into one of the deepest implications. Scarcity does not reward intelligence, it rewards readiness. In moments of scarcity, the world does not care how smart you are, how articulate your analysis is, or how persuasive your arguments are. The only question that matters is, were you positioned before the recognition wave? If yes, you benefit. If not, you pay the new price. Or you step aside entirely because you're priced out. Scarcity filters people. It does not negotiate with them. Another layer many forget is how scarcity expands inequality. Not financial inequality, resource inequality. When a material becomes essential and limited, those who secured supply early are not just wealthy, they are structurally advantaged. They can produce, they can operate, they can deliver, they can continue. Everyone else cannot. This is why silver is not merely an investment story, it is a continuity story. a civilization story, a supply chain story. People think inflation or interest rates will determine silver's trajectory. But prices do not rise because of macro speculation. Prices rise because industries cannot secure adequate supply, and when that happens, everything upstream and downstream adjusts violently. Let's zoom out even further and address why silver is entering a repricing phase, not a bull market. A bull market is when an asset becomes more desirable. A repricing is when the world realizes it has fundamentally misunderstood the value of the asset. In a bull market you climb. In a repricing you leap. And silver is positioned for a leap because its price does not reflect its structural function. Silver is priced like a commodity. It behaves like infrastructure. It is treated like an investment. It functions like an industrial lifeline. Markets often misprice assets for long periods. But when mispricing meets structural scarcity, the correction is not gentle. It is violent. You can already see the signs: delays in physical delivery, premiums above spot, industrial buyers forming long-term contracts, nations stockpiling, solar manufacturers revising their forecasts, EV producers projecting silver consumption increases. These are not speculative signals. These are continuity signals. These are emergency signals. These are early warnings of structural stress. And yet, the average investor still thinks of silver as a trade. They haven't realized the truth. Silver is becoming a strategic asset. Not in the military sense, but in the survival sense. Anything that enables electricity, computation, medical function, or energy transition becomes strategic by default. The world is electrifying. Electrification increases silver intensity, and silver intensity compounds over time. This is not a linear demand curve, it is exponential. Because each new technology phase requires more silver per unit of output, not less. Efficiency does not reduce silver demand, it increases it. Why? Because as devices become smaller, more precise, and more energy dense, they require higher quality conductors, and silver is the best conductor on Earth. This is not hype, this is physics, and physics does not negotiate. When an asset's physical function outgrows its financial reputation, the financial markets become the last group to understand what is coming. That is exactly where silver stands today. Industrial reality has already shifted, geological reality has already shifted, supply chain reality has already shifted, but the financial narrative has not. And narratives always break last. They break suddenly, violently, and without warning. By the time the average investor wakes up, the market has already moved into a new regime where the rules no longer resemble the old world. This is what a repricing event looks like. Not a slow climb, but a sudden recalibration of value imposed by reality, not speculation. To appreciate the scale of what lies ahead, you must understand something deeper. Silver does not need a crisis to reprice. The crisis is already embedded in the structural math. Production cannot scale fast enough. Consumption cannot slow without halting progress. Industrial applications cannot substitute cheaper materials, and the derivative market cannot paper over physical constraints forever. This means the repricing is mathematically embedded in the system. The only variable is the trigger. The moment recognition crosses a threshold, the system can no longer absorb. We are approaching that threshold. Not because of hype, not because of FOMO, but because industries are quietly restructuring to secure future supply. A solar manufacturer doesn't sign a multi-year silver procurement contract unless they fear shortages. A battery company doesn't redesign their long-term sourcing strategy unless they expect rising constraints. A mint doesn't ration coins unless physical bullion is harder to acquire. These actions are not emotional, they are structural. They signal the early stages of resource prioritization. Resource prioritization is one of the most important concepts investors overlook. In a world of abundance, everyone has access. In a world of constrained supply, access becomes hierarchical. Industries take priority over investors because they need the material to continue operating. Governments take priority over industries when national security is at stake. Strategic sectors take priority over non-strategic sectors, and individuals, the smallest unit in the system, are last. This is not cynicism. This is how nations function when materials become limited. It has happened with energy, with rare earths, with semiconductors, and it will happen with silver. So the critical question is, what happens when industries and investors want the same ounces at the same time? The answer is simple. Investors get pushed aside, not because they're unimportant, but because they are non-essential. Industries do not buy silver to make money. They buy it to survive. Investors buy silver to gain advantage in a future system. Industries buy silver to ensure the system doesn't collapse before they get there. Survival always wins over speculation. Continuity always wins over opportunity. This is why the next phase of the silver market will not be defined by investor behavior. It will be defined by industrial necessity. As silver intensity increases in solar panels, electric vehicles, circuitry, and grid components, demand will keep rising independent of price. Price is a financial metric. Industrial necessity is a physical metric. The two metrics are about to diverge dramatically, and when they diverge, you get something extremely rare in financial markets, a material that becomes more essential as it becomes more expensive. Normally, higher prices reduce demand. With silver, higher prices signal worse shortages, which encourage industries to accelerate procurement. This is the inversion point, when demand rises because prices rise, not despite it. That dynamic destroys normal supply-demand curves. It creates a vertical structure where price becomes a byproduct, not a driver. To see how rapidly this can escalate, imagine a single major electronics manufacturer announcing they will secure 3 years of silver supply to hedge against industrial disruption. That action alone could drain meaningful chunks of available inventory. Now imagine if 2 manufacturers do it, or 5, or an entire sector. Scarcity is not linear. It is exponential. It compounds. Once a critical mass of industrial buyers shifts behavior from as-needed purchasing to strategic stockpiling, the market enters a feedback loop where each purchase accelerates scarcity further. This is what many analysts miss. Silver is entering a phase where the bottleneck is not price, but availability. And the moment availability becomes uncertain, price becomes irrelevant. When a material is essential, you do not negotiate. You acquire whatever you can, at whatever cost, because the cost of not acquiring it is existentially higher. This is why the future of silver won't be defined by investors bidding up price. It will be defined by industries outbidding everyone else. Let's return to the psychological cycle to understand where individuals fit into this process. In stage 1 and 2, individuals ignore the opportunity because it seems unnecessary. In stage 3, they notice the rise but interpret it as temporary. In stage 4, they begin to chase. In stage 5, they struggle to find supply. In stage 6, they cannot access it at all. This is the tragedy of scarcity cycles. The people who need protection the most scramble the latest, and by then the window has closed. This is why positioning matters before recognition. Decisions made in disbelief shape outcomes long after belief becomes universal. No one gets rich understanding the truth when everyone already agrees with it. By then, the reward has already migrated to early adopters, to those who saw structural signals before emotional acceptance kicked in. This is why the line, "Scarcity does not reward intelligence, it rewards readiness," is not just philosophical. It is operational. It defines the winners and losers of every resource transition in history. Let's zoom into the derivative market once more because this is the part most likely to break first. Derivatives function on assumptions of liquidity and deliverability. As long as physical supply is abundant relative to claims, the system works. But when claims multiply faster than supply, and they always do, pressure builds. When industrial buyers begin asking for guaranteed physical allocation instead of cash settlement, the derivatives market begins losing its role as the price anchor. When enough physical demand migrates outside the derivative system becomes a spectator, not a driver. This flips the entire pricing mechanism upside down. Right now, the derivative market still believes it controls silver. It doesn't realize it has already lost control. The future price of silver will not be set by traders. It will be set by combinations of miners, refiners, industrial giants, and strategic stockpilers. Once pricing power shifts from financial participants to physical participants, the old game ends. A new game begins. We must now address the final and most important concept, the continuity threshold. The continuity threshold is the level of inventory below which industries cannot rely on predictable supply. It is not zero. It is not even close to zero. It is the point where procurement managers begin securing material early. It is the point where lead times stretch. It is the point where availability becomes inconsistent. Once the continuity threshold is breached, industrial behavior flips from passive to aggressive. That is the moment the repricing event accelerates. Every chart you see, every analysis you read, every price target, every model, they all assume continuity. They assume silver will be available. They assume lead times will remain within reason. They assume industrial buyers will behave rationally. But under structural scarcity, continuity assumptions fail. When continuity fails, prices recalibrate violently to reflect physical constraints. A world built on electricity, sensors, solar, mobility, and connectivity cannot function without silver. And yet the world has priced silver as if it were abundant. This mispricing is ending. The final mirror moment you must face is this. The world is not moving toward a high-price silver market. It is moving toward a low-availability silver market. Price is a symptom, not a solution. A high price does not fix scarcity. A high price does not add supply. A high price does not reverse geological timelines. A high price does not create new mines. A high price only reflects the desperation of a system trying to secure something it cannot replace. So here is the real question, the only question that matters. When the world finally realizes silver is essential, strategic, scarce, and structurally underpriced, where will you be? Will you be someone who understood the magnitude early, who positioned before the recognition cascade? Or will you be someone trying to buy into a system that no longer has enough to offer? Because when the industrial bidding war begins, when governments quietly accumulate, when multinational supply chains attempt to lock down multi-year contracts, when delays stretch into quarters, when premiums decouple from spot, when physical supply dries up before derivative markets adjust, investors will not be participants. They will be spectators. They will not be buyers. They will be observers of a resource that has moved beyond their reach. This is not fear. This is physics. It is not speculation. It is structural math. It is not hype. It is the inevitable outcome of consumption exceeding production, of inventories collapsing, of supply chain fragility, of industrial necessity, and of a financial system built on assumptions that no longer match reality. You prepare for scarcity before scarcity is obvious, not because you want to profit, but because you want to participate in a future that requires the very material the world has taken for granted for too long. The final line is simple, and it is the truth that defines every resource transition in history. Decisions made before recognition define outcomes long after recognition. By the time the world understands what silver truly is, the world will already be too late.